morning, ladies and gentlemen. A fine start to the week on Dalal Street. This Monday, the Nifty, Bank Nifty, and many other indices, especially the metals and the IT sector, have bounced back strongly after a major correction. What also comes as good news is that Goldman Sachs, the world's best known investment manager, has also upped its intentions on the Indian market, hoping that the Nifty would be crossing 29,000 in the medium term. That itself is a 13% appreciation from where the markets are at this point of time at 25,623. To discuss this and a lot more, we are now joined by Mr. Amit Goel. He's the co-founder and chief global strategist at Pace 360. Mr. Goel is a very well-known investment manager as well as strategist on Dalal Street and has decades of experience behind him. Namaste Amitji and a very warm welcome. We get together on a fine day as far as markets are concerned. All looks well on Dalal Street after a massive correction. How are you viewing sentiment today?
Thank you, Shell, and thanks for having me on. So I think the sentiment is recovering. I would not say that we are at the the sentiment is euphoric. The sentiment is recovering because we've been sideways for a very, very long time, and all of us, the Dalal Street participants, have been waiting for a breakout on Nifty and the Indian stocks for a very long time, and the market has flattered to deceive on many, many occasions, particularly in the last 4-5 months. There have been times when it appeared that we are just about we are at the cusp of breaking out, and then we are going to going to make a new all-time high. But every time we went close, but then we corrected. So this time, for me, it does genuinely look like that we are ready to break out, and it does genuinely look that this time for a change we will not just be at the cusp, but we'll actually break out, make a new all-time high, and then maybe even stretch for a little while further. So my sense is that the sentiment is doing okay. It is because of many times that the markets have flattered to deceive. So people are a little cautious, but this Goldman Sachs upgrade is definitely, it has come at the right time, and I think this will also play its role in sort of giving a little support to the market, and also in making the sentiment a little more positive.
Absolutely. This report, which hopes to see Nifty beyond 29,000 somewhere at Christmas time in 2026, is indeed a shot in the arm. You very rightly mentioned this, Amitji. Now, between the time we last met and today, two important things have happened. Gold and silver have gone parabolic, and part of their rally has also corrected. People have booked profit. At this point of time, Amitji, what is the allocation of money over 4 or 5 different asset classes that you track? How much of it in precious metals? How much of it in equity? And within equity, what is your preference?
Sure. Absolutely, Shell. So the current allocation is, let's say, about 20% in equities. It is about 75% in fixed income, and only about 5% in precious metals, because as you very rightly put it, they went parabolic, and the levels that they went up to, gold and silver, in the month of October, there was, you had a feeling that this has also become a kind of a bubble in its own right, at least from a near-term perspective, if not a long-term perspective. So we are considerably lighter on precious metals now. We have a very small presence there. Equities, we are in the process of taking up the stakes. So we were sitting very, very low on equities, but now we are in the process of taking it up, and we'll take it up even more in the next few days. And rest is, of course, fixed income, which is which is still earning us something like a 10.5 to 11% post expenses. So that is like it has been like a good anchor for us in this time of volatility when equity markets were doing very little. And it is liquid enough for us to be able to take out money from there and put it into equities at any point of time, which is precisely what we are doing.
Okay.
And we are looking forward to a rally over the next let's say 4 to 5 weeks in the Indian equities, and hopefully we should be able to cash out a good chunk of our equities when we believe that the rally has already played out.
Okay. Amitji, I'm a bit surprised that about 60 to 70% of the corpus is in fixed income. This, if I remember correctly, was double A corporate rated paper, if I recollect my last conversation with you.
Absolutely, Shell. It ranges from A plus to double A plus. The average rating, if we can put it that way, would be close to double A minus to double A.
Fair. As long as you made money and avoided volatility in the market, it's all fine. End of the day, we have to make money rather than be with our favorite asset. Favorite asset is the one that makes money.
Yes, absolutely, Shell.
Okay. Now this 20% allocation in equity which you retained, what was this invested in? And this fresh money that you want to pour in from corporate bonds, where is this going?
It is basically Shell. Even right now, the money is in ETFs. So it is in Nifty and Bank Nifty ETFs. And even going forward, we would be investing in ETFs and not in individual stocks. This is because we believe that the coming rally would have a large cap and a blue chip bias. And whenever you feel that, then it is always better to A, avoid small cap and mid caps, and B, we feel a lot safer with diversified ETFs of large cap blue chip stocks than picking up individual names. So we would be focused on ETFs this time, and going forward also we are going to increase stakes there. But we do intend to also add Indian IT stock ETFs, apart from, of course, banking and apart from Nifty and maybe a bit of Next 50 as well.
Okay. Uh, Again, we are discussing something which is catching me off balance. I wonder why, a good stock picker like Amit is preferring ETFs over stocks.
Shell, you are very generous with your words. I'm not such a big stock picker because basically we are macro top down, and we have always played themes in the market rather than individual stocks in a very big way. But of course, when we believe that the rally has, let's say, 3 or 5 months to play out, that is a time when we usually focus on individual stocks. But when we believe that the runway is a little shorter, we prefer ETFs because individual stocks when you pick up, you need a longer gestation time for them to play out their respective stories. But when you are picking ETFs, you can easily be more opportunistic in your outlook. So for us, the game is very clear. If we believe that the runway is shorter, we would pick up ETFs. If we believe that the runway is longer, we would pick up stocks. And there are times when the markets are coming out of a bear market, and we believe that the stocks are a good story for the next few years. And that time it is never ETFs. That time it is always individual stocks. And at that time, in fact, they have a mid cap and a small cap bias. But this time, this definitely does not have a 2 year runway. This definitely is not looking like a small cap or a mid cap rally. So this is time to be opportunistic for us and play for a reasonable bounce in the markets. So this type of a rally always qualifies for ETFs and not individual stocks. Of course, it would differ from one fund manager to another, but for us, this is going to be largely about ETFs this time.
Okay, fair point. One has to be conscious of the fact that it could be a short lived move in the market, and therefore position yourself accordingly. Amitji, again, not exactly a theoretical question, but as they taught us in Mahabharat, ये यक्ष प्रश्न है, why large caps over mids and smalls?
Because Shell, we believe that the overvaluation is a lot more uncomfortable in small and mid caps than it is in large caps. So what has happened is that the earnings have been relatively muted. But of course, this particular quarter, which has just ended in September, the earnings were slightly better than expectations. So what has happened is that the large caps, because of the fact that they went nowhere in the last 1 year, and because the fact that we did have at least some nominal growth in earnings, even though the real growth was literally nothing to write home about. So because of that, the large caps are back to the 10-year average. So the 10-year average P is where we are. So let's say for our Nifty, on a trailing basis, we would be at about 22, and on a forward earning basis, we are, let's say, at about 20. So this is a fairly more comfortable valuation for somebody like us to step in. But as far as the small cap and mid caps are concerned, the valuations are still uncomfortable. Of course, there are exceptions. If somebody can pick up stocks which go up parabolic from here, good luck to them. But we do not rely on that capability of ours to be able to pick up those hidden gems which will go parabolic from here. So the valuation comfort does not exist for us in the diversified portfolios in small cap and mid cap, but it does exist for us in a large cap blue chip portfolio. And even Goldman Sachs, they have basically upgraded Nifty. They have not talked so much about our small cap and mid caps. So I think this definitely has some large cap and blue chip bias, and plus the valuation comfort, plus the fact that FIIs may turn buyers again, and they would obviously buy more of large caps than they would buy the small cap and mid cap. So I think all these factors come together for us to get convinced that we need to play large cap, we need to play blue chips, and we need to play a short term to a mid term rally and not a medium term to a long term rally.
I think that's a very sensible, practical outlook, given the fact that it's the second day of an uptick. Now comes another question, Amitji. Uh, how much of this money will move from corporate bonds to equities in your portfolio?
So I think max we would go up to 50% shell. That's the ceiling for us, because for us this rally is not going to take us to 29,000, which Goldman Sachs has talked about, and they've talked about a slightly longer time frame. We are looking at basically let's say a Thanksgiving to a pre-Christmas rally all over the world. And this time, for a change, India could outperform, because I think the AI frenzy is sort of dying down. And the money which was chasing South Korean and Taiwanese and the the relevant AI stocks in China and Hong Kong, that money, some part of that money is going to come to India. So this looks like a 4 to 5 week rally, and we believe that we do not want to go beyond 50% in any case for this rally. Longer term, we are pretty negative. So you can take up the stakes in equity when you believe that even if you go wrong in the near term, there you have comfort in the medium term to longer term. But because of the fact that we believe that a huge bubble was made in the form of AI and technology all over the world. So, whenever in the past those kind of bubbles have popped up and they are deflated, the effect is felt pretty much all over the world, even in those markets where there is very little of AI and technology stock representation, and India being one of them. So my sense is that because right now we have valuation comfort and we have tailwinds, but longer term the story is a little different because of the AI and tech bubble all over the world, and we are talking about 2026 being the year of deflation of that bubble. So we do not have medium term to long term comfort as far as we are concerned. So all this means that we will not go beyond a point in equities, and we will be relatively near term to medium term focused, and we will be focused more on large caps and blue chips where the entry and exit is relatively easier and the moves are little more predictable than compared to the small cap and mid caps. So this is basically the genesis of this entire strategy, Shell.
Okay. So, for our viewers, let me just paraphrase. For the moment, Amit feels that this rally, although it has strong legs, will be for the next 4 or 5 weeks till Christmas, and it is a part of a broader structure that's opening across global indices. It's always best to focus on ETFs in the short term rather than stocks. If you have a horizon beyond 2 3 years, then stocks matter. But for the moment, ETFs, and those also of the large cap variety, are looking good because large cap valuations have harmonized towards the 10-year mean, and the small cap and mid cap valuations still look a little on the higher side. Now, coming to gold. Amitji, I'm sure you booked profit from this very smart rally that happened. But what has been the general feel, or the sense that you're getting from gold and silver? Is it over and a sideways move ahead, or are better times still coming?
I think Shell. I'm quite wary of gold and silver because of the kind of price action we saw between August and October. Uh, the price action, the behavior of their movements, their volumes, and plus the general behavior of the investors around us, it was very suggestive that that this is like a frenzy, and we've managed to make a bubble out of these commodities, and we'll probably the bubble is going to get popped, and which is my opinion even today that gold and silver would have to undergo a relatively long process of correction and consolidation for them to become viable again. Having said that, because they peaked out around let's say the 17th to 20th of October. Silver peaked out on 17th of October and gold peaked out on 20th of October. It was followed by a very swift correction in both of them, and silver in dollar terms went down from 54 to 45 and a half, and gold went down from 4,375 to literally 3,850 or thereabouts. So, because the fact that the correction was also very, very sharp and pretty deep, my sense is that in the very, very near term, they may not do badly. In fact, they may do even somewhat better than what they have done in the previous couple of weeks. But I think this has to be a long, drawn out process of correction and consolidation. You would see waves of buying and then you would see waves of selling, but it will be a long time. In my opinion, at least 6 months, if not 12 months, when gold and silver would have sorted out the excesses of the previous three months and they become genuinely viable again. Till then, you would see those waves, you would see those opportunistic rallies and then corrections. But pretty much for a long-term investor, you can wait for a better level and a better time to buy them.
Okay. My final question, Amitji, at this point of time, uh, what are the assets apart from equity that you are hopeful on the long side?
That's a very, very good question, Shell, because that's exactly what we try and do at all times. My sense is that the long-term government bonds, right now, of course, we can focus on India because we are basically talking about the Indian markets. I think Indian 30-year bonds, the yields are right now at about 7.25%, and the gap between 30 and 10 years in India is now as high as 75 basis points. This is now a very comfortable level for any long term investor to come in. And unlike our approach on equities and precious metals, where it is largely opportunistic, here we can literally talk about a longer term investment scenario. And I think over the next 2 to 3 years, we believe that the interest rate cycle is still headed down. And what has happened is that while RBI has taken down the interest rates, but in the meanwhile, the gap between the short term rates and the 10-year yields have gone up, and the gap between 10 and 30 has gone up even more. So, because of this, the transmission of the reduced RBI rates in India has not been as robust because the longer term rates pretty much remain flat or maybe even elevated. So RBI is also very concerned about this because we are not at that stage in the economy where we have the luxury of having longer term rates at higher levels. So RBI is going to talk it down, and they will probably expect more OMOs in the near future. Right now, the liquidity is tight because RBI has been selling dollars because foreign investors have been taking out dollars. So, because of all those factors, the yields have gone up. So, my sense is RBI would want to talk it down. And at this stage of the economic cycle, we are very, very sure that the gap between the 30 and the 10 has to go down from 75 to less than 50. And the gap between 10 and short term rates also has to go down from the current about 100 basis points to probably about 50. So, which would mean that your 30-year bond yield, which is at 7.25% in India, it could go down to about 6.25% over the next 1 to 1.5 years, which makes it a very nice double digit return with very little volatility and with very little risk. So this is an asset class where we are bullish for the long term, and not just in India, we are also bullish on US, Japan, and UK 30-year bonds. So I think 30-year government bonds is a good place to be in, and they are looking very good for the next 1 to 2 years.
Okay, ladies and gentlemen, that essentially means if you want to have a very long and peaceful sleep and lock in 7.25% confirmed sovereign guaranteed bond, then you should look at the India 30-year bond. That is what Amit is trying to say. As always, Amitji, it's such a pleasure to listen to your very calm, collected, and wonderful views. Thank you for your time, and we look forward to having you again.
Thank you, Shail, for giving me this opportunity and for always asking me the right and the best questions to extract the best out of us. Thank you so much again.
Very kind of you, Mr. Goel. We look forward to your next presence with us on the channel. That, ladies and gentlemen, was Mr. Amit Goel, co-founder and global strategist at Pace 360. They are moving money away from Indian corporate bond markets to equities slowly, and within equities they are focusing on large cap ETFs of the Nifty and Bank Nifty for a short term rally which might take the market higher over the next 5 weeks or so till Christmas. The view on precious metals is a still more nuanced. Better days ahead for gold and silver, but the next 3-4 months is where gold and silver will try to absorb the volatility that it has seen in the last 1 month. So that's the view on precious metals. ETFs, large caps and mid caps, smalls and mids, Mr. Goel feels that they are still in terms of valuations a bit higher. So it's possible that the money that is coming in from overseas just might overlook them for a while, but large caps are the new darlings of the Lal Street. With that, ladies and gentlemen, we leave the market in very strong hands on this lovely Monday morning. The Nifty up 157, Bank Nifty adding almost 200, and the IT index taking it away 2% higher, 730 points, 35,850. Thank you for your time. Please continue watching all the action on Business Today Television. Have a nice day.